Welcome to the Deep Dive. We take the sources you care about and extract the knowledge you need fast.
Helping you get straight to the point.
Today, we're laser focused on a big question. What does the future hold for the cryptocurrency market in 2025?
Exactly. You've shared some really insightful material. We'll be diving into Equito's Crypto Market Outlook 2025. It's pretty comprehensive.
Right. And we also have an Investopedia piece, just clarifying the sort of legal basics for crypto.
And a fascinating thesis I saw from Diva Portal, looking at machine learning for predicting Bitcoin prices. Interesting stuff.
Our mission is pretty straightforward. Cut through all the noise, the hype and fear around crypto forecasts.
Yeah, there's a lot of that.
And really pinpoint the key trends and potential shifts that could actually matter in the next year.
Okay, let's get into it.
Okay, so the Equito report kicks off pretty optimistically for 2025. It's predicting a continued bull market. What's fueling that confidence?
Well, the report points to several key drivers, but maybe the most significant one is the expectation of substantial new investment. We're talking about traditional institutional players.
The famous institutions.
Yeah, exactly. I mean, the crypto market, even with all its growth, it's still relatively small compared to, say, global equities or bonds.
Right, so even a small allocation from them could be huge.
Precisely. As these big funds start to allocate even a tiny percentage of their capital, it could really move the needle on prices.
Okay, that makes sense. We're talking pension funds, endowments, those kind of big players finally moving in. What's making them more comfortable now?
It's a convergence of factors, really. First, there's just more familiarity, all the marketing around Bitcoin ETFs,
You couldn't miss it.
Right, and key leaders talking it up. That brings crypto more into the mainstream conversation.
Okay, so less niche, more known.
And the ETFs themselves, practically speaking, they lower the hurdles. They simplify how these institutions can actually trade and hold Bitcoin.
So the plumbing is getting better.
Exactly. Then there's regulation. We're expecting, or the report expects, greater clarity in the U.S., especially with the current administration's stance. That adds comfort.
Less uncertainty.
Less uncertainty. Plus, you have favorable macro conditions, a relatively strong U.S. economy, the anticipated start of a rate cut cycle that generally creates a positive backdrop for investing.
Right, tailwinds from the broader economy.
And the U.S. election, that really acted as a catalyst. It ushered in a political environment that's seen as, well, more crypto-friendly.
Okay, so it's like a mix of easier access, more comfort, and a friendlier political climate.
That sums it pretty well.
The report also mentions demand shocks. What does that mean here?
Yeah, this is interesting. It's about the limited amount of Bitcoin that's actually readily available for trading. A lot is held long term.
Ho dealers.
The ho dealers, yes. Equito estimates that because of this scarcity, every dollar of new institutional inflow could have a much bigger impact on the price.
Bigger than 1 to 1.
Way bigger. They suggest a multiplier effect of maybe 20 to 30 times.
Wow. Okay, 20 to 30x. That's potentially huge.
It is. And there's also this idea of reflexivity in crypto markets. Meaning rising prices tend to attract more demand, which pushes prices up further, creating a kind of positive feedback loop.
Got it. So demand fuels price, which fuels more demand. A bit of a snowball.
You could say that, fueled by that limited liquid supply.
Okay, let's shift gears a bit to the political and regulatory side. The report really flags the impact of the recent U.S. elections. What are the main takeaways there for crypto?
Yeah, the Republican gains are seen as a significant positive by the report's authors, mainly because some prominent Democrats had been quite vocal in their skepticism.
So a shift in the balance of power.
Right. It suggests a potentially more accommodating regulatory path forward. But what's also interesting is the growing support for crypto on both sides of the aisle. It's becoming less partisan.
So maybe more constructive regulation is possible.
That's the hope. The expectation is this could lead to, say, more tailored rules for decentralized projects, maybe ending some of the big lawsuits against exchanges.
That would be significant.
And maybe paving the way for more diverse crypto ETFs. Think index funds or sector-specific ETFs.
Tailored rules for DeFi. That sounds like a big step. The report also says personnel is policy. How does that apply here?
Right. It just means who gets appointed to lead the regulatory agencies, the SEC, FDIC, OCC, even the Fed matters a lot.
They interpret and enforce the rules?
Exactly. The new administration is expected to nominate people seen as more industry-friendly or at least open to innovation.
Any names mentioned?
The report specifically mentions Paul Atkins as a potential SEC chair candidate, someone viewed as more pro-crypto. These kinds of appointments could lead to a more flexible approach.
So it's not just the laws on the books, but who's actually running the show?
Personnel is policy, yeah.
Okay, let's zoom out to the macroeconomic picture. The report seems a bit mixed here. Positives and negatives.
Yeah, it's definitely not all sunshine. On the plus side, the outlook suggests continued strong U.S. economic and earnings growth,
Okay.
and the expectation of Fed rate cuts, at least initially. The U.S. stock market seems to like that combo. But there are real uncertainties. Rising U.S. bond yields could kind of cancel out the effect of rate cuts. Inflation is proving stickier than hoped.
Still a problem.
Still a potential problem. And some policies from the new administration, like tax cuts or tariffs, could actually add to inflationary pressures.
Right. And what about outside the U.S.?
Well, global economic struggles and the threat of U.S. tariffs are casting a bit of a shadow over non-U.S. markets.
And the report mentions U.S. debt.
Yeah, it flags the uncontrolled growth of U.S. national debt and the deficit as fundamentally unsustainable long-term. That's a big cloud on the horizon.
So a complex picture. Strong U.S. growth maybe, but with inflation risks, debt issues, and global headwinds.
That's a good summary. It's a balancing act.
The report then talks about a new economic paradigm, mentioning the BRICS nations. How does this fit in with crypto?
This is a really interesting, bigger picture point. The growing economic weight of the BRICS bloc, Brazil, Russia, India, China, South Africa, and the newer members.
Right, they're challenging the traditional order.
In terms of purchasing power parity GDP, yes. And this puts pressure on the US dollar's dominance, this whole de-dollarization trend we hear about.
And crypto's role.
The report speculates the US might see crypto, maybe Bitcoin as a reserve asset or supporting dollar stablecoins as a way to counter this.
Interesting. Using crypto to bolster the existing system.
Potentially. And at the same time, some BRICS countries like Russia, maybe even China, seem to be softening their anti-crypto stance a bit.
So crypto's caught in these big geopolitical shifts.
It seems so. And if the US were to signal interest in holding Bitcoin reserves, that could really boost demand, positioning it as a diversifier alongside gold.
So crypto is becoming part of the global economic strategy discussion, it seems.
It appears that way.
Okay, so pulling it all together, the report calls 2025 a potential watershed year ahead. Why such a strong statement?
It's the expectation that several key trends will really accelerate. First, institutional adoption moves from early interest to actual significant allocations.
The ETFs being the main gateway.
Primarily, yes. Bitcoin ETFs make it much easier. Second, that clearer, more positive regulatory environment we talked about is expected to materialize in the US.
Okay.
So those two should drive much bigger inflows into crypto ETFs. We're talking moving beyond just hedge funds and retail into the larger pension funds, endowments.
The slower moving big money.
Exactly. Their due diligence takes time. The report mentions BlackRock even put out a crypto asset allocation report signaling this shift.
What about Ethereum ETFs?
Interest was slower initially, but it's picked up.
Yeah.
And the potential for staking yields within ETH ETFs could be a big draw.
And beyond Bitcoin and Ether.
The prediction is we'll eventually see crypto index and sector ETFs, which could attract a lot of passive investment when they become feasible.
Okay, ETFs are a major theme. What else makes it a watershed year?
Stablecoins. 2025 could be the year they start making inroads into actual payments, beyond just crypto trading.
Though most volume is still trading related now.
For now, yes. But the potential for payments is there. And finally, tokenization.
Tokenizing real-world assets. We've heard about that for years.
We have, but the infrastructure is really being built out now by major players: Goldman, JP Morgan, BlackRock, Franklin Templeton.
The big names are involved.
They are. Forecasts from BCG and BNY Mellon are pretty optimistic. The report suggests 2025 might see a real breakthrough in user adoption for tokenized assets.
Okay, quite a bullish outlook overall for 2025 then, based on institutions, regulation, ETFs, stablecoins, and tokenization.
That's the core of the bull case, yes.
But of course, there are always risks. The report outlines several. Let's get into those. Inflation is the first one mentioned.
Right. The worry is that the macro picture could deteriorate. If government spending keeps rising and policies fuel inflation, that's a risk.
And the Fed might be boxed in?
That's the concern. Bond yields are rising even with rate cuts, suggesting the Fed might not have as much control as they'd like. Limited maneuverability.
Okay, inflation risk. Then there's the liquidity cycle. What's the issue there?
The idea is that rate cuts just aren't having the same punch they used to. Quantitative easing seemed more impactful recently.
So the Fed's main tool is less effective.
Potentially. Borrowing costs are actually rising in some areas despite the cuts. So the current easing cycle might not be stimulating things as intended.
Got it. The report also mentions concentration risk. Where?
Two main areas flagged. First, Tether. It's still dominant among USD stablecoins, like 75% market share.
And the concerns about its reserves haven't gone away.
Exactly. So the market's sensitive to any bad news there. Though, interestingly, the report notes a potential positive. Howard Lutnick, whose firm Cantor Fitzgerald holds Tether's reserves, might have a role in the new administration.
Interesting political connection there. What's the other concentration risk?
Large Bitcoin holdings. Think MicroStrategy, maybe even governments eventually.
MicroStrategy uses leverage too, right?
Yes, and that leverage position plus their sheer size could attract regulatory scrutiny. There's also the hypothetical risk of Satoshi's dormant coins moving. Unlikely, but, it's out there.
Okay, so stablecoin dominance and large whale holdings are things to watch. What about a bubble?
Well, looking at things like funding rates, the report says there aren't really signs of a broad Bitcoin bubble right now, but the huge outperformance of meme coins is a bit of a worry.
Because it's pure speculation.
Mostly, yeah. Especially when you see slower user adoption for other crypto use cases, it could indicate a speculative bubble in that specific meme coin corner of the market.
Makes sense. And finally, the report mentions geopolitics. Always a risk.
Absolutely. Geopolitical tensions are extraordinarily high right now. Any serious escalation, Middle East, Ukraine, and economic conflict with China could easily spook markets, including crypto.
Okay, so definitely need to keep an eye on inflation, liquidity, concentration risks, meme coin froth, and geopolitics as potential headwinds.
Those seem to be the key ones highlighted.
Now let's talk altcoins.
Yeah.
The outlook here is a bit more muted. Alt season may disappoint is the phrase used. Why?
Several reasons given. First, better regulation, while good overall, might actually level the playing field. It might not necessarily favor the existing altcoins over potential new compliant ones.
Okay, regulation could be a double-edged sword for some alts.
Potentially. Second, Bitcoin ETFs. They give traditional investors an easy way to get exposure without necessarily needing to rotate into riskier altcoins later.
So maybe less rotation from BTC to alts this cycle.
That's the theory. Then there's value leakage. We're seeing growth in transaction volumes on layer 2s, but that activity isn't always translating into higher prices for the layer 2 tokens themselves. The value isn't fully accruing.
Interesting. Disconnect between usage and price.
And related to that, user traction for many actual applications like decentralized social media, gaming, prediction markets, it's still pretty muted overall.
Still searching for that killer app beyond trading.
To some extent, yes. Examples like Friend.tech, Farcaster, Lens are mentioned. There's potential, maybe UXLINK gets traction, but broad adoption isn't quite there yet, which keeps a lid on many altcoin valuations.
And meme coins again.
Yeah, the report argues the current alt season, such as it is dominated by meme coins. This diverts money and attention from more productive projects.
And maybe hurts crypto's credibility.
Potentially, yeah, especially with new investors coming in.
Okay, so a more cautious outlook for altcoins generally in 2025. This leads to the discussion of winners and losers. Where's the focus shifting?
The report suggests a renewed focus back on the base layer, the blockchain protocols themselves.
Why?
Because of the challenges applications have faced and the ongoing need for better scalability, interoperability, security, the core infrastructure.
So fixing the plumbing is back in vogue.
Seems like it. VC investment is reportedly shifting more towards infrastructure projects again.
And Ethereum. The report calls it a crisis. That sounds strong.
It does sound strong. It notes Ethereum's underperformance compared to Bitcoin and Solana, price-wise.
Linked to the merge or competition?
Potentially both. Plus, a decline in its share of Layer 1 revenues, and even some renewed inflation on the network. And as we said, institutions seem to prefer Bitcoin right now.
So, challenges for the dominant smart contract platform. Who's winning them?
Challenger blockchains are highlighted. High-performance ones like Solana and the so-called Solana killers, SUI, Aptos, say.
Driven by meme coin activity mostly.
That's been a big driver of activity and fees, yeah. The report questions how sustainable that is long-term, stressing the need for broader application adoption.
Any others mentioned?
Blockchains with access to large existing user bases, like Toncoin integrated with Telegram or Treon, are also pointed out as potential winners.
And Bitcoin itself, what's its identity?
The report touches on that ongoing debate. Store of value versus medium of exchange.
Where does the report lean?
It suggests that government interest in Bitcoin as a potential reserve asset really reinforces the store of value narrative. Using it for everyday payments still seems impractical due to volatility.
Okay, so store of value seems to be the dominant narrative being reinforced.
That's the takeaway, yeah.
It's fascinating how dynamic this all is. Different layers, different narratives. You mentioned SUI as a Solana killer from the report.
Yeah.
We actually have some recent market data on SUI.
Oh, interesting. What does it show?
Yeah, this is from a Binance Square analysis dated May 20th, 2025. SUI was trading around $3.80 then.
Okay.
It had seen a modest bump, like 2% in the previous 24 hours. But the bigger picture was a strong uptrend since April, over 115% gain.
Wow, quite a run.
Yeah, but it hit resistance around $4.15 to $4.30 and was consolidating, trading in a range between $3.70 and $3.85 when that analysis was done.
So catching its breath after a big move.
Seems like it. Support was noted around $3.75 and $3.50. Resistance, $3.94, and then that $4.30 zone.
And technical indicators.
They suggested strong bullish momentum, but maybe a bit overheated short term. RSI and Williams-Purcell were in overbought territory. MACD was bullish. ADX showed a strong trend.
Okay, so bullish, but maybe due for a pause or pullback. And just remind us, what is SUI?
You're right. It's a layer 1 blockchain, focuses on scalability and speed, uses an object-based design, developed by Miston Labs.
And backed by some big names.
Yeah. Investors include A16's, FTX Ventures back in the day, Binance Labs, Franklin Templeton, Coinbase Ventures. Quite the list.
Got it. So one of the key challengers the main report highlighted.
Exactly. Now, we also have that thesis you mentioned from Diva Portal, using machine learning to predict Bitcoin prices. How does that fit into understanding the future?
Well, it's a different angle, right? Instead of fundamental analysis or macro views, it's about using algorithms to find patterns in historical price data.
Trying to quantify the trends.
Exactly. This thesis aimed to see which machine learning algorithm worked best for long-term Bitcoin predictions, using technical indicators, RSI, moving averages, things like that.
Which algorithms did they test?
They looked at random forest, gradient boosting, and then two types of neural networks often used for sequences, LSTM and GRU.
And what did they find?
Well, their literature review suggested these algorithms do show promise for crypto prediction in general, in their own experiment.
Yes.
The LSTM model generally performed best based on standard error metrics, RMSE and MSE. Random Forest had a slightly better MAE score, though.
So LSTM seemed like the winner overall in their test.
Based on those metrics, yes. For example, LSTM had an RMSE of about 0.01, MSE of 0.0001, and an R squared of around 0.8.
Okay. Did any specific indicators seem more important?
Interestingly, they found that the moving averages, EMA and SMA, seemed to have a bigger impact on the model's performance than RSI did, in their study at least.
And the thesis acknowledged the risks, obviously.
Oh, absolutely. It stressed the inherent volatility, the potential for big gains, but also big losses. Standard crypto disclaimer, really.
So machine learning isn't a magic bullet, but it can offer insights.
That's the idea. It's a tool. It can help spot patterns in historical data that humans might miss, giving another perspective on potential market dynamics.
So definitely not a crystal ball, but another piece of the puzzle when trying to analyze things.
Exactly. It's about using data-driven methods to try and make more informed assessments in a notoriously unpredictable market.
Well, this has certainly been a deep dive. We've gone from institutional flows and regulation all the way to machine learning predictions for 2025.
Yeah, we've covered a lot of ground. The potential for a continued bull market driven by that institutional money and regulatory shifts.
The rise of stablecoins, tokenization.
But also the risks, inflation, concentration, geopolitics.
The more, let's say, nuanced outlook for altcoins compared to Bitcoin, maybe.
Right, and the performance of these challenger chains like SUI and how AI is being applied to try and forecast prices. It's a complex picture.
It really is. So as we wrap up, here's a final thought for you, the listener, to mull over.
Considering all these interconnected forces, you've got institutions coming in, regulations changing, tech evolving, global economics shifting.
What single factor do you think will ultimately have the most significant impact on the cryptocurrency market in 2025?
It's a tough question because they're all linked.
Definitely something to reflect on as you navigate this space. Thanks for taking this deep dive with us.